Very good morning, friends. Today's session is about ratio analysis. So friends, what is ratio analysis? Ratio analysis is nothing but, in a simple language, it is the analysis of the financial statements and similarly interpretations of financial results of a particular period of operations with the help of ratio is termed as your ratio analysis. We are analyzing the ratios and interpreting a conclusion for a specific term or a period of operations with the help of it ratio it's termed as ratio analysis. So friends, ratio analysis is used to determine the financial soundness of a business concern. A ratio is nothing but it refers to a relationship or a mathematical relationship between any two interrelated variables. In other language or other words, you can say as it establishes a relationship between two items expressed in quantitative or number form. So what is ratio analysis? A ratio we are studying a comparison or a relationship between two interrelated variables. We are getting, by viewing the financial statements, we are getting a ratio. By seeing the ratio, we are coming into a conclusion or aiming to a decision making. The aim is for everyone, the aim is to make a decision, a prompt decision at the right time, at the right place. For this, ratio analysis is the most important step. So what is ratio analysis, friends? Okay, the balance sheet and the statement of income or profit and loss account are essential, but they are only the starting point, the initial point for a successful financial management. After it, we should apply ratio analysis. We had been given a balance sheet and a profit and loss account. By seeing, we can come into a conclusion. To come into a conclusion, we analyze it. How we analyze? By applying a ratio analysis to financial statements to analyze how the company is moving into in the market, how it is performing, how is the progress of a company, is it succeeding, it is in failure. So what is the company as a whole? By seeing into the industry wise company, main business concern company, etc. So for to apply ratio analysis, there are formulas. So formulas enable the manager to spot trends in a business and to compare its performance in the similar industry or businesses. To do all these, we need to compare the ratios for several successive years, watching especially for any unfavorable trends that may be starting. Okay, so ratio analysis is simply, we will be getting a balance sheet, a profit and loss account. These are the initial step to start with analyzing the ratio analysis. Post getting it, we will apply here ratio analysis by applying the formula. Let's say for gross profit divided by net sales. So we apply the formula, apply ratio analysis to financial statements. We can analyze how is the business currently performing. Okay, as in a market, how is performing, as a whole, how it's performing. Then why we use formulas? To enable, because formulas are given, like their reason behind some significance is there. Okay, so the formulas enable us or the manager or the creditors or the investors, some or the another, the formulas are being given some trends they are indicating. By seeing those trends or by assuming those trends, we can come to a conclusion or to come a decision. Okay, so why, as a management point of view, why they are doing to do this? Because they are comparing their ratios with other ratios, with other companies ratios in the similar industry, or they are comparing their ratio by seeing the future successive years ratio, what it be. They are assuming the future ratio. Also they are seeing the previous ratio, the past ratio, how it's there, how it's currently performing, how it should be or it should be performed in the future. So my dear friends, what will come under balance sheet? We will just have a quick gist on it. In balance sheet, they are segmented into two: liabilities, asset side. Under liability side, their net worth, also known as equity, also known as your own fund. In it, mainly friends, share capital, all your capital, reserves, and your credit balance in your profit and loss account. These all would be coming under your liability side net worth heading. Share capital, your partner's capital, paid up capital, owner's fund. Then comes your all your reserves, capital reserve, general reserve, revaluation reserve, and your other reserves. Last comes your credit balance in your profit and loss account. In liabilities, second heading is your long-term liabilities, also known as your borrowed funds. In it, mainly term loans would be coming, long-term, so term loans given by banks, institutions. Then comes your debentures, bonds, unsecured loans, fixed deposits, other long-term liabilities. The third heading comes your current liabilities. Under current liabilities, coming as your bank working capital limits such as your cash credit, overdraft, bills, export credit, sundry creditors, then your bills payable, short duration loans or deposits, expenses payable, and provisions against various items. So these all are coming under the heading of liabilities. Liabilities, net worth, long-term liabilities, and your current liabilities. We'll just see in the asset side what is being coming. So in asset side, mainly fixed assets are coming. Fixed assets, land and building, it's fixed. Land and building, plant and machinery, furniture and fixtures, where in all you will be getting a depreciation, reduction in the value of your fixed asset. So original value less your depreciation will come as net value or book value method or written down value method. Then comes your non-current assets, investment in securities, shares, old stocks or old dispute or book debts, long-term security deposits, other miscellaneous assets which are not current or fixed in nature. Then comes your current assets. In current assets, your cash and bank balance, marketable or government securities, book debts, sundry debtors, bills receivable, stocks and inventories. In inventory, raw materials, stock in progress, finished goods, stores and spares, advance payment of taxes, prepaid expense, loans and advances recoverable within 12 months. Then comes your intangible assets. Under intangible assets, your patents, goodwill, debit balance in profit and loss account, your preliminary expense or your pre-operative expense. These all come under the heading of intangible assets. Subheading is there and the main heading is assets. So liabilities and assets. Liabilities, net worth, long-term liabilities and your current liabilities. In assets, fixed assets, non-current assets, current assets, intangible assets.